So without further ado, if I get a thumbs up or something from Rod in the background that he's ready to come on, we'll go ahead and give him that special intro and get him back on Benzinga Live. Mr. Alzmann, how you doing today?
I'm doing well. How about yourself?
Pretty good. All right, before we get started, any thoughts on my rant? Have you gotten any flights canceled over the past few months?
I haven't flown in a little while, but yeah, I've read the same in the news, and yeah, just more negativity to seep through to consumer sentiment, right?
I know it's just frustrating. It's one of those things where it's like first world problems. Like, oh, I got a flight to I don't know, New York City for a fun week, and then it gets canceled. Like, it's not the end of the world, but it's just obnoxious.
Yep.
All right, Rod. So, like I mentioned, you founder of GMEDD.com. Maybe I think it would be helpful before we get into the new stock pick, which you may be given a little bit of clues about with your apparel choice today. But maybe just for anyone who's new to the show or isn't familiar with you, can you just explain how you I want to know exactly how you got started, maybe in finance in the markets in general, but then what was your first impetus to like start looking into GameStop, to start doing this research?
Okay, let me try to be condensed with it because it could be a long story. I'll try to
Okay.
hit short. GameStop was the first stock I ever bought when I was a teenager. I was 14-ish, 15-ish. I've always been very nerdy, very interested in finances. So my dad had set up custodial accounts for me and my siblings, and I was buying video games in the mall. The GameStop and the electronics boutique were always packed. So, Peter Lynchism, right? I saw it looked busy. I liked video games. Bought it in 2004 or so, my first ever stock. Sold it before I went off to college in 2007. So that was my first individual equity investing experience at a pretty young age. Fast forward to 2017, I got back into GameStop. I would tell everyone, I think that this is kind of misunderstood. Obviously, everyone's aware of the secular headwinds from the digitization of the physical media that plays the gaming software, right? You can download a game rather than buy a disc, which GameStop's gross margin was largely derived from the resale of those used games and hardware. So 2018 goes by. I go on social media because I'm like, what am I missing? I want to talk to other people and understand what their perspectives are. 2019 comes along. The stock has a long squeeze when the company slashes its dividend to zero. It goes from $16 to $3 by August 2019. Mike Burry writes a letter to the board, and the rest, is kind of history. In 2020, though, we all are stuck inside. Many of us, folks who haven't maybe been investing for some period, are getting familiarized with the markets through ease of, we had commissions eliminated in late 2019, and then we had everyone, again, doing nothing but deciding they're going to trade. So 2020, met a lot of people online, met Keith Gill through his Roaring Kitty chat, spent a lot of time working on the GameStop thesis, kind of as part of that little community that it was a couple dozen of us. Everybody hated GameStop. Ryan Cohen bought it in August, and yeah, it was just an incredible ride. For me, it was a value investment. Actually, it was just a deeply misunderstood opportunity. For example, the balance sheet at one point had $5 in net cash, and the stock traded at like $3. Like, this thing was just hated, loathed. 140% of the float was short at the peak. It was over 100% for much of 2020, and shorts decided that their thesis was correct, that it would be bankrupt in spite of the facts being against them, and craziness happened. But the GMEDD kind of came about because in October, there started to be a lot of paid bot attacks on a lot of the social media networks. So you couldn't actually communicate with people on stock twits anymore because you just have a wave of the same message repeated. So we started looking for different channels to communicate. Obviously, Keith had his Roaring Kitty stream, which a lot of us used effectively, began to use Discord. GMEDD was really, once Ryan Cohen settled with the GameStop board on Jan 11th, 21, we wanted to kind of in one place capture all of the research and hard work that had been done to show why our viewpoint was what it was, which we put out that report actually kind of as counter programming to Andrew Left of Citroen's reporting on it. And coincidentally, within 2 weeks, the stock mooned. We put $169 bull case price target, and obviously the stock surpassed that. But by and large, it's been very close to that price target, above it or slightly below it for much of the last year and a half. So I think we were largely right that it was misunderstood and that there was an interesting growth opportunity to shift toward e-commerce and digitization. It's gone differently than we'd anticipated. I no longer have a position, but still run the site. Joe Fonicello, who does a lot of the management of the site, he also doesn't have a position. It's just a passion project for us because still, I think we see a lot of misrepresentation in media, and it's just, I think we've kind of considered it. Let's just be that voice of reason, that voice of our attempt at truth and objectivity. So that's GMEDD and investing, and Wook Capital is another thing that we can talk about. But yeah.
Yeah, and what I think is so, like, interesting and, even kind of ironic about the whole GameStop saga, especially looking back on it now in 2022, kind of with, like, the hindsight lens, is once, the stock the GameStop stock really started going crazy and short squeezing, like, the whole GameStop and AMC, community or people that were investing in it, I feel like got grouped as, at least on Wall Street or in financial media, as this group of, like, dumb people that really didn't know what they were doing. But the way it started was really exactly the opposite, like a group of smart people like yourself, Rob, that looked at this and Keith, and looking at this through that fundamental lens, saying, okay, people are missing something here, and doing that, like, true fundamental due diligence research in the same way that, like, a Warren Buffett or Michael Burry would do. And that's how it started. And then
Yeah.
basically, once all the masses got involved
Yeah.
and it got co-opted, turned into completely the opposite, where it was people that were buying GameStop that really didn't understand the thesis. Like, I think they understood the short squeeze thesis, saying, oh, if
Yeah.
this many
People
are
buying GameStop, January 26th, 27th, were not buying it because they saw it as a long-term viable investment with a good return from 200, 300,
exactly,
whatever dollars. It was,
which
I'm
that's how
going to
it
try to squeeze it.
started.
Yeah.
That's how it
So
started.
let me just interject. Yeah, there's I am on record in many venues saying not so nice things about the people who are proud to be ignorant. I don't think that is investing. I think that's gambling. But they made a movie out of the folks who were kind of early on in that I participated in, GameStop Rise of the Players. You can stream it on Hulu now for free if you have that. And I think that Jonah Tullis, who directed it, did a great job of actually catching the story of this little ragtag group of contrarian-minded people who thought they saw something differently. And that's kind of how I don't like the word contrarian, because I think it's like, to claim you're a contrarian is automatically like, come on, man, shut up. But I do typically think it goes back to like a Howard Marxism. You need to think differently than the market and be more correct than the market. You need to have that kind of variant perception. So I think about a lot of the investments that I've taken large positions in of late. Playboy, I talked with you guys, and I think it was January, about Playboy. So unfortunately, that's experienced a meaningful drawdown. But Allison Transmission is another one, where it's a commercial automatic transmission maker for heavy duty trucks and buses and military equipment, off-road mining and energy equipment. And the viewpoint, right, the Kathy Wood viewpoint, is that electrification is happening, oil goes to $12, everything internal combustion dies. And my viewpoint, as somebody who worked at Ryder System, one of the largest truck leasing and rental companies in the nation, for 5 years in corporate strategy, with my entire work focus being on disruptive technology, is quite different than hers. That it's actually going to be a very slow pace of adoption when it comes to heavy duty vehicle electrification. And Allison Transmission is trading at its lowest multiple since it came public in 2012, for example. So I think it's generating a low teens free cash flow yield. And I think it is, and it has continued to buy back about 10% of its shares per year for the last 5 years on average. So it's one of those things where it's like the market can be wrong for a very long period of time. GameStop, it was, I felt like I was wrong for years. Allison, I talked to another investor who's been in since 2017, and it's like, yeah, we're flat since 2017. Well, multiple compression is a bitch. So, the reality is there's nothing wrong with the business. It's just that perceptions change. And I think a lot of tech investors thought they were the smartest guys in the room because multiple expansion gave them life-changing gains if they sold in 2021 on the back of Fed liquidity. And now, obviously, we're seeing the reversal of that. So, with investing, I'm not really a trader, right? I know you guys have some traders on it, and look, nothing wrong with people trading. That's fine. But if you're actually taking multi-year, long-term viewpoints on these things, you have to think deeply about competitive advantages, disruption, et cetera. And you have to be comfortable being wrong, or at least letting the share price tell you you're wrong for a long period of time.
Yeah, and we talk about that a lot on the show, just the distinction between trading and investing. I think it's like a Charlie Munger quote where he's like, investing is really finding a few good companies and then sitting back and doing nothing. Like investing, it should not be something you're like, you should be very active in the research and due diligence
Right.
process. But then once you find and pick those companies that you want to be invested in, you really don't have to be that active. One thing I do both, right? Like I am primarily a
Yeah.
long-term investor. I have on the side a Robinhood account that I'll trade some options on just for fun, like where I know like I would never put my money that's in my investment account into my Robinhood account because it's just completely separate in my mind. But something I'm curious about, Rod, for you, at least like strategically as an investor. So say you take this long term horizon, which is different for some people. If you're Kathy Wood, it may be 5-10 years. If it's if for someone like myself who's 25, like I might buy into a company today and have it for 30 years. But when do you, if ever, are you looking at selling some of these positions?
It is a complicated question. You do obviously have tax considerations. If you're 25, I hope you're maxing your Roth every year and you're opportunistically making good bets in your Roth. I was very fortunate that I had most of my GameStop allocation in my Roth, so I now have a bit over $1 million in a Roth IRA, which
Oh
I'm
wow.
33. That's pretty great, and I can't retire. I can't touch the money. It's I'm still going to invest it for 26 more years, whatever, until I'm 59 and a half. But you sell when the forward return is below your hurdle rate. Like if stock runs up a lot and you've already pulled forward all of your forward returns, it doesn't matter how much you like the company, you sell. Owning the stock, like and I kind of see this a lot with a lot of the memes, right? Like AMC, like, oh, I want to own AMC because I love movies, and that's okay. But there's actually more attractive investment opportunities in the movie theater industry, or you could buy AMC debt, for example, because when the company becomes insolvent, which is kind of my base case, the creditors are going to end up owning the company. And it's not that AMC will go away, the brand will exist, but creditors will take over the company. But yeah, in terms of when to sell, if your thesis is broken, like if something fundamentally has changed about the underlying, that what you thought was true at first is no longer true, and it's not, that's likely a good time to sell. Bill Ackman did that pretty quickly with Netflix. So kudos to Mr. Ackman, right? When that bad quarter came through, he said, you know what, that our thesis was growth, and now it's a very different story. So I'm going to GTFO. And that's something that you learn from experience, right? You don't need to diamond hand something to zero just to be proud of it. If something has changed, you should get out. Like I think of Bed Bath Beyond, for example, the last 2 quarters have been pretty devastating in terms of the amount of cash that enterprise has burned. The situation looks pretty grim when you think that all of their competitors are also over inventoried and they're likely going to be discounting. So I they may successfully spin or sell their Buy Buy Baby business and unlock some value for shareholders. But when you look at the bonds, it looks like the enterprise is priced as though it'll be insolvent and or bankrupt and have to restructure at some point in the next year or two, which may or may not happen. Right? Everything in investing is a probabilistic bet. You are making the bet with all the information which there's a lot of information that people don't uncover, and that's I think kind of core to the thesis behind Wook Capital, where I'm the managing director. John Kim is the CIO and founder, and John and I met through GameStop. John had at one point owned a little less than 2% of GameStop. And getting back to your question of when to sell, I know it was really difficult for John because he was a very large shareholder. He had a conversation with Ryan Cohen in, I think it was December of 2021, just talking about his vision. This is all before Cohen settled with the board. So this was when John reached out to him on LinkedIn. Literally DM'd the guy on LinkedIn and had a conversation about what his investment thesis was. And I included John's shares when I wrote Cohen a letter on behalf of 4% of the retail shareholders saying, you have our support with what you said in your November 2021 letter. So like, there's a lot of stuff that retail investors can do and be more active in their investment approach. But to your point, like Charlie Munger said, you really, a lot of it, people should just be sitting back, and a lot of people should probably just be more so in index funds if they're not going to do their own due diligence and put the legwork in to actually like uncover and understand individual equities. But yeah, I know that's a long way of saying it really does depend. But if your stock goes up way beyond what you thought it's worth, you should. Why are you holding it? To sell it.
Right. And I think that's where it gets difficult for a lot of long-term investors. Like, think about for people who might have bought Apple in like the mid 2000s and are up 1,000% on it. But it's like, yeah, but I bought Apple because I love it and I still love it. And I want to keep hanging on to it when it's like, and that's where I think you have different strategies where if you do have a stock that's truly up more than 100%, you can cut like half your position and still have your, initial value that you put, so I think that's an option where you can trim some of your positions without having to get completely out of them. And
right. I think something in that exact vein is Costco, right? It's one of those never sell. It has an incredible business model, shared economies scaled, right? There, so many people love the business. It's an incredible business model. I spend thousands and thousands of my dollars there a year, but I don't own the stock. And it was in April, I had tweeted something like, Costco, great company, but what kind of return are you getting from here? And I again, timing, sometimes you're lucky, sometimes you're not. I didn't trade it, but I had basically top ticked it when I said that. And some of the responses were like, oh, but it's Costco. And it's like, okay, but when you look at what these current valuations are, how do you get a return going forward that is going to meet what you need? So to your point, you should probably sell some. And if you want to maintain a tracking position or whatever, obviously there's tax considerations that if you've, owned Apple for 20 years and you sell it, you're going to have a big tax bill. So, or Costco likewise. So that does complicate things, but take the tax out of the consideration and it's just very simple. Like what is your forward internal rate of return at this point in time? You have to look forward in investing, and too many people get obsessed with looking backwards, looking only at the present. And that's why I think things like Playboy, for example, people don't understand what the enterprise is actually going towards. Like Gretzky says, skate where the puck is going. This company has completely shifted its business model. From 2019, they had 0 direct-to-consumer sales, and now it is primarily a direct-to-consumer business that has no media business. The magazine's been defunct now for more than 2 years. So I think a lot of investing has to do. And look, I'm 33, so I don't know anything. I've been doing this for a little while, but you got to listen to and follow what the really smart people who've been doing this for many decades have done. Read the books, listen to their interviews. Seth Klarman is a good listen for sure for if you're more of a value investor. But like when I think of value investing, I don't think of it like a Graham perspective of like I only look at the financial statements. You have to incorporate the business. You have to incorporate more into your thinking than just looking at numbers on a page. And yeah, I think like with Playboy, I look at the survey data that shows me that their target consumer, the Gen Zs, they are known globally by more than 90%. They tout this unaided brand awareness of 97%, but I've seen survey data that's 90 plus for younger people too. So you have a brand that's known by almost everybody, that is selling things. And for example, the data I saw that 60% view it as a different brand today than it was in the past. And I think that's important because a lot of older folks think of it as one thing, right? A magazine company of naked women, with cultural componentry, right? They had a lot of famous interviewees in the magazine, but the business today is now a lot different than that, and that's kind of what I mean.
Yeah. Okay. So I've got a few thoughts, kind of a long-winded conversation here, bouncing around from different things. I wanted to go back first. No, not your fault at all. I actually like it this way as opposed to having like super organized. All right, we're going to talk about this, that, and that. But I did want to bring up Playboy. Obviously, wearing the shirt. This was the stock I saw you tweeting about. You've been talking about it for a while now. I did want to back up for a second because that
it's an ugly chart.
It is an ugly chart. Talking about the Bill Ackman Netflix thing, like you said, I think that's a point I wanted to reiterate for a second. That's actually a very, very useful skill to have as an investor, being able to have that kind of, being able to essentially put pride, put ego aside and say, hey, I got this one wrong. It happens. I'm going to cut my losses. Like Bill Ackman could have very easily said, and like Pershing, whatever his company, fund is called, we're going to buy more Netflix down here. It's
double
at a
down.
We're going to double down. We're going to dollar cost average in.
I'm in hand, baby.
But they decided to do the opposite. And like, that's something that we should all look at and say, like, okay, Bill Ackman, one of the most famed investors out there, has got millions and millions of dollars at his disposal for research and all these more resources than we have, still gets a pick wrong once in a while and able to do that and cut the losses instead of doubling down on it. I just wanted to address that really quick because I think that's like a very important lesson that I think a lot of people think all about. Investing is all about like making the right picks and making the right trades. But what happened? It's just as much about knowing how to manage, when you do get one wrong. And the best investors don't really lose a lot of money. The best investors make a lot of money, but also the best investors don't lose a lot of money. And that should be one of your primary goals as an investor, is to preserve capital.
110%. That is the mentality that should be present. But I think in the last 2 years of mania mind, everyone's been in the YOLO mindset, upside only, how much can I make, as opposed to how much can I, what's my downside risk? How can I steadily grow this capital I've worked very hard to save and opt to invest? So 100% agree with you there. Capital preservation and understanding risk management, vital. And a lot of folks who are new to markets who came in, after 2020, after, Fed liquidity pump, it's like you're brand new. Don't assume you know more than the people who've been doing this for a long amount of time and that you've magically uncovered some sort of cheat code to markets. Try to be humble. I remember when I was in high school, I blew up a trading account as a senior in high school. Zeco, if you remember, they were the first zero commission trader, back in 2007. And I was trading options, blew up several $1,000s worth of losses that I could have had a smaller student loan bill come when I got done with undergrad. So some people, you have to experience the pain of blowing up an account to kind of better understand what you just said about capital preservation. So I share that to say, like, this happens to a lot of people, and it's much better for it to happen when it's a small amount of money than when it's
right. When you're it's better when you're 20 and have a few $1,000s in an options account than when you're 50 and you're doing it with your retirement account.
100%.
And then I know you said earlier, it's
but yeah, do you want to talk a little bit about Playboy?
I do. So I was just gonna say I don't. I'm not gonna sit up here, and I know you said you don't like when people just say, "Oh, they're a contrarian," because it's like, to me, like I agree. It's like the person that says they're always a contrarian. They're the person that's like, you're having a good time. The Beatles are playing, and they're there sitting like, the Beatles really aren't that good. It's like, come on, man, just enjoy. Like, come on, like you don't need to always be the devil's advocate. But I am gonna play devil's advocate with you for a minute here, Rod, if that's okay.
Yeah.
Okay, so sell me. So if I'm sitting here as an investor and saying, okay, I get it. Playboy's different than it was 2 years ago. Playboy's different than it was 20 years ago. Playboy's different than it was 40 years ago. But if Playboy is primarily today now a direct-to-consumer business that has a super strong brand, and I know how big essentially Playboy's streetwear part of its business is, right? Apparel, you're wearing the t-shirt now. And I know it's huge in China, right? Like in China, people love the Playboy Buddy, people love the streetwear. But like, why is that exciting to me as an investor? There's a bunch of exciting, tech companies out there, companies doing exciting things. Why is essentially a streetwear company with a strong brand exciting to me as an investor?
I'll go back to one of the investors. The investor who initially put it on my radar had been published in Barron's writing about GameStop in February of 2020. And really what he said, he sent me a very brief note. He said, "What do you think this brand's worth? I think it could be worth billions." And I thought to myself, yes, it is a brand that is truly irreplaceable. You could not create a brand like this today with the embedded cultural aspects, all of the history. Obviously there's some negativity, but when you think about younger consumers, that's stuff they haven't necessarily lived with, and that's their new target. But I step back and I think, all right, so you have a brand that doesn't really require CapEx. It's a licensing business it was a media and licensing business. It was a money-losing media and licensing business, right? Hefner sold it to private equity, Rizvi Travers, who Rizvi is still the largest individual shareholder. The head of Rizvi is the chairman of the board. One of the partners at Rizvi is the CEO, Ben Cohn. So there's still a lot of that. I think that does scare some people off. But Rizvi paid, what was it, 218 million, I think it was, in 2011 or so. When you think about the fact the company has acquired Honey Birdette, they acquired Yandy.com, they acquired this chain of sex accessory stores out west called Lovers, and they did all these acquisitions in the last few years that they've cobbled together. So you're at this kind of inflection point where they have a lot of duplicative cost baked into this model. They've built out the necessary framework to scale when it comes to selling direct to consumer. Now they have a digital channel, they have warehousing, they have in-store, they have the licensing business where they've been pretty capable at growing those partnerships. One of the more promising ones was with Drake's OVO label, and I saw that those sold out pretty much instantly, all of the collab products on OVO site. So you have a licensing business that requires almost no replacement capex. Yes, there's SG&A to keep the brand relevant, but that's fine. From a what do they have to spend capex on? It's just incrementally growing the Honey Birdette store base. So, like, for context, right now the enterprise value, I mean, the thing is down again today, right? So it's about 500 million. They bought Honey Birdette, which is an Australian luxury retailer. I actually put a tweet out. I have it pinned about a year ago to the day, and they paid $330 million for 28 million in EBITDA, 73 million in revenue. But what did they get? They got a design team who can design in-house lingerie and sex toys, which the gross margins for Honey Birdette were just shy of 80% when they acquired them. So it is a luxury brand with very high margins. So they now have the capabilities of design team that they can now spread that across in-house design Playboy lingerie, Playboy swimwear, etc. They have the distribution capabilities. So the issue, though, is right now you have a ton of cost baked in. So they're running all these duplicative backend systems. They haven't done all of their ERP integrations. Wook Capital met with the CFO Lance Barton a few weeks ago, actually, just to talk about that. Lance had kind of said, "Look, we're in a sprint right now. We're trying to get it done, and they're targeting getting it done before their busy season comes up because they are a very seasonal company. You think about Halloween, a lot of costumes. The official Playboy Bunny costume is actually, I think, the first uniform trademarked by U.S. Patent and Trademark Office, interestingly. But they are trying to get that done. But I don't think you really see inflection until 23 and beyond in terms of cost, because you have like all these duplicative systems, a lot of duplicative costs that you can't take out until you get through all of that. He said they're trying to get it done by Halloween. They probably are going to have to shut it off, though, when they come to busy season, and they won't get it done. They may not get it done until 1Q23 or 2Q23, which was what I had initially thought 6 to 12 months ago. So you have to look out. You have to look at what do they own. You have a business that doesn't require any incremental capex, but for them opening Honey Birdette stores, which cost about $700K each, and then have 30% four-wall EBITDA. Like, there are so many opportunities. The issue for them is that management started to pursue a bunch of different ones, and I think right now, clearly, the market says, "Show me the money," and they were not cash flow positive. They've guided that they will be barely for 2022, but I don't really worry about that. When you look out, they have hundreds of millions of dollars of contracted licensing minimums through next decade, and I think people just miss it. And I could be wrong, but I see a very bright future for what they have at their disposal.
Yeah, and I mean, so to me, like so it sounds like you're a little bit critical of the management in terms of just expansion and the money spent on some of these other things. Where the real key here, I think, what you're seeing from the long side is, I mean, look, this thing is trading at under a 300 million market cap. The enterprise value is more than 500 million. And the company, like you're saying, just through its licensing arm, which takes essentially little to no effort, it owns all of its rights. It gets to license that out to, can end up being more valuable than where the share price is right now. And I mean, like you said, the chart's ugly. Looking at this, I could see where eventually this gets to a price, and maybe that price is now where almost analogous to the GameStop situation, that people are really overlooking the value of this company because of all these other essentially problems.
In January, I said it was already giving me GameStop 2019 vibes, so it's played out pretty much as I expected. Unfortunately, war happened and the economy is deteriorated, so they are consumer discretionary. Their factor is wrong. They are a de-SPAC, so they're hated despite having no warrants and despite having raised over 200 million in follow-on capital at 46 per share. So there's a lot of stuff that on its face is ugly. But then when you really dig into it, it's actually mind-boggling to me that it's trading at these levels. I'm more concerned that somebody kind of steals them at these levels. I was concerned about that with GameStop, and thankfully it didn't happen. When they were trading at like $3 per share, I thought that Microsoft or Amazon even would just say, "Wow, I can literally get this massive nationwide footprint of thousands of stores for nothing." But that story played out differently. So they're going to be facing challenges. I do track things very closely. For example, sequentially, I track order numbers, and I saw that their Honey Birdette sales were actually up on a gross order basis in the mid to high single digits from 1Q to 2Q domestically. So you're not seeing that their luxury brand has fallen off yet. Obviously need to watch it closely. And there's timing of cash flows because they get remittance payments from the Chinese licensees twice a year. So if you look at their balance sheet right now and you were to look at the cash flow statement in the last quarter, it's like, oh my God, these guys burned all this cash. And it's like, there's a little bit of a timing issue and there's some nuance there. So look, like with all things, there's always risk. It is entirely plausible that China invades Taiwan and they lose access to those payments from their Chinese licensees and the company goes bankrupt. That's a risk. Do I think that's a
That is a
material
risk.
risk?
That is certainly a risk. There's a lot of risk in equities involved.
Exactly.
If that happens, though, there are a lot of
Yes.
companies that
It's not just Playboy that's going to zero.
right.
A lot of folks are going to be hurt.
If that happens, yeah, I mean Taiwan Semi, all these companies. Well, Rod, we do got to run. I really appreciate you coming on. It was great to catch up with you. I'd like to get you on kind of more frequently, especially as
Sure.
this Playboy story kind of plays out. It'd be good to kind of get updates from you on it, because I'm sure you're going to be following the Playboy story more closely than I am. We've actually had Ben Cohn on the show a few times, so maybe we can coordinate a time where we can get you all on together. That'd be fun.
I'd love that. I've had the opportunity to meet with Ben before, and John had the opportunity to have lunch with Ben, and yeah, we have a good relationship. Would love to. That'd be great.
All righty, Rod. Well, enjoy your weekend. Enjoy your 4th of July. I see some people in the chat talking about Playboy's history. Look, bottom line, a lot of companies have, some history, things that aren't great. But I think Playboy actually gets a worse. I mean, Playboy for a while was actually a very much a they were empowering women and they were proponents.
Oh yeah, it's like 80+% of the company is female. If you're thinking that the things that happened under Hugh Hefner have any bearing or relevance to Playboy, to PLB Group, you're mistaken. And that's not to discount those things, right? That any victims of any sort of abuse, like those people should be heard. They should have the right to tell their stories, and if the perpetrators are still around, they should be brought to justice. But to conflate what the business today is with what it was, I don't think that Hugh Hefner is the brand. I think the brand is actually just the original lifestyle brand. It's having a good time. It's freedom to do what you want. It has a lot of that libertarian ethos. So we can talk more about that next time. Totally appreciate though that there are negatives, and that is a risk. But fortunately, the consumer base they're targeting, I think, is more embracing of the direction they've pivoted to from all the survey data I've seen. And as you can tell, I'm a pretty data-driven guy.
100%. All right, Rod. Well, enjoy your weekend. Enjoy your holiday. Like I said, I'm excited to get you back on more frequently to talk about the Playboy story and anything else you're watching, because I know you've got some good insights just on.
I would
overall...
love to talk about Allison Transmission. Your audience will hate it, but I would love to.
Okay, I don't care. We'll do it. We'll do it. I'll hit you up. Maybe not next week, but the week after.
Okay, sounds good.
All
Thanks
right,
for having me.
Of course. Have a good holiday weekend. All righty, guys. That was Rod Alzmann. He really impressive in terms of, was one of the guys that we were talking to really while the whole GameStop thing was going on, and someone who, is out there doing his own due diligence, not just kind of regurgitating what's written on Twitter or Reddit. So someone that I really appreciate his insights and research.